Hey, so we've all heard of down payment assistance programs, or what a lot of people call first-time homebuyer programs. But today we're going to get into all the details of what that actually means, who qualifies, and a lot of the myths associated with it. But believe it or not, at the end of this, you'll be able to see how you can actually buy a house for $1,000 out of pocket. So let's get right into it. Okay, so let's get into what it takes to buy a home for $1,000 down. But let's dispel the number one myth about these programs, and that is that it requires you to be a quote unquote first time home buyer. So a lot of these programs do not require that this is the first home you've ever owned. Some programs require at least one of the borrowers be a first time home buyer. So the more accurate description of this program, rather than first-time home buyer, is down payment assistance program. That covers more broadly what it actually is. So what are the main reasons why not everybody owns a home? Well, the two biggest contributing factors are low credit score, or what they perceive as a low credit score, and low savings. So a lot of people think you need a perfect credit score and a ton of money in the bank, which a lot of people don't have, so they just give up before they even start. There is many ways to overcome bad credit or low credit, and to get those scores up, I have a link in the description for some credit hacks that I provide that cost zero money and are super easy to boost your credit, sometimes massive amounts in points. Obviously, with this program, we're solving the next problem, which is the lack of having $15,000, $20,000 sitting in your savings account waiting to buy a house. So where do you begin in this whole journey of trying to figure out how to buy a house? Well, I can tell you 100% you need to start with the mortgage part of it. I am a real estate agent and mortgage broker, and I can tell you before you even talk to me on the real estate side, you need to figure out the mortgage side. So what you need to do is reach out to a mortgage broker. Why a broker? A mortgage broker is not beholden to one bank or one lender. They should have an expansive portfolio of people that may not meet some people's needs, but they may meet your needs. It doesn't pigeonhole you into one little box that might not fit. So basically, if I'm explaining it and giving an analogy, let's say you contact an insurance company, Allstate. You're going to get Allstate's quote for that day and what Allstate offers. If you contact an insurance broker, they're going to shop Allstate, State Farm, and a gazillion other insurances to see who likes your policy and can give you the best deal. That's essentially what a mortgage broker does. So why are we even having this discussion? Why not just rent? Well, if you're watching this, you're probably fed up for one of many reasons of being a renter. One of the big things that I see, I have some rentals. So one of the big things that I see when people come to look at my rental is they're in a frantic because they just found out their landlord / homeowner decided they want to sell randomly. So they're going to be out on the streets within a month and they have to find a place to live. So that can offer people a huge insecure environment where maybe you have your kids in school in that district, or just having to uproot your lifestyle period because the owner decides to sell. That's one of the main points that I hear. Also increasing rent. So every time your lease is up, or depending on what kind of contract you're in, rent can go up. When rent goes up, you don't know what your payment's going to be the next time. So uncertainty is a huge thing. Obviously, a lot of people in shared communities like apartments and condos, you have to deal with loud music, noisy neighbors, trashy neighbors that throw their garbage everywhere, loud barking animals right next to you, a variety of things that come with a shared community, high theft, vehicle break-ins, all that stuff. More than likely, one of these points is why you're watching this video and you're tired of it. At the time of this recording, rates are higher. Why would anybody tell you to buy right now? That is a great question. So let me tell you what happens historically. When rates come down, which they will at some point, when rates come down, demand goes up. So what do you think happens when rates get back down to 2s, 3s, even 4s? Well, people are going to go out shopping again. What does that mean to you? So what are sellers looking for when they accept offers? They love, typically a cash offer is king. But not a ton of people have cash offers. So what's the next best thing that sellers like to accept? A conventional loan with 20% down. That is the safe buyer in sellers' minds. What is one of the least desired offers they tend to take? Down payment assistance. So for the last couple years, if you have tried to buy a house using a down payment assistance program, you've probably had very little luck, which is why you're watching this video. So you can try to wait out the market till the rates come down, but historically, your chances of actually getting the home go down to next to nothing. Because if we're just being frank, it's the least desired offer, at least in the seller's mind. There's nothing wrong with the down payment assistance program or the offers, but in the seller's mind, they want to gravitate towards somebody who's putting more money down. They feel more sense of security with that. In addition to the sense of security they're getting with a conventional offer, part of this whole down payment assistance program is the down. It's in the title. So down payment. What it doesn't account for is closing costs. So let's say that you're in a market where rates have come down and you get lucky enough to get your down payment assistance program offer accepted by a homeowner. The next step with keeping your out-of-pocket expenses to $1,000 is getting the seller to pay your closing costs. So for the last couple years, if you came in with a down payment assistance program offer and you asked for them to pay for your closing cost, they will most likely laugh you out of the market. They'll shred your offer. It will go nowhere. So we have finally pivoted to a market where sellers have a hard time selling. They are offering a ton of money to buy your closing costs out, to buy down your rate and various other things that didn't exist these last few years when the market was hot. Another reason why now is prime season for first-time home buyers or down payment assistance buyers that had no chance in a market before. So if you are renting right now, you're still paying a mortgage. It's just not yours. It is the landlord's mortgage. So whether you rent or whether you buy, make no mistake about it, you're paying a mortgage. It's just a matter of whose. So do this calculation, and this might shock you. Let's say your rent, let's just average it out. Let's say your rent is $2,500 a month, which depending on what state you're in or where you're at, $2,500 may be on the cheap end. So using a $2,500 rent a month, times that by 360 months, which is what's in a 30-year loan. So that's the typical loan period that people get. So times out 2,500 times 360, which would be the equivalent of a 30-year loan, $900,000 is what you will have forked out in rent and own absolutely none of it. So let's go over some average cost in the Denver metro area. So right now for a studio apartment, that is a 1-bedroom studio apartment, you are looking between $1,772 and $2,050 for a 1-bedroom studio. For a 2-bed average cost, it is $2,666, between that and $3,394, depending on location and the type of house. That is an insane amount that you are putting to own absolutely nothing. So let's talk about rent inflation. So each year that goes up, if you take historical data from wherever, 1960 to 2022, obviously home prices, rent, mortgages, all that has gone up massively. What is the difference? So let's say you get into a house today and you lock in a rate for 30 years. You know, minus property taxes and insurance, you know what that payment is going to be for the next 30 years based on your principal and interest rate. So it's in stone. You know what it is. Now, fast forward, do you have that same sense of security 5-10 years from now, what the rent cost is going to be for that studio apartment or whatever you're renting? It's going to go up tremendously. Who knows what that's going to be or whether that keeps up with your wages. So you're probably asking next, how the hell can I afford a house payment right now in 2022 with the rates the way they are? Well, the question is how are you affording rent? There's a good chance you have a roommate or roommates to make up some of the cost of living that you have right now to make it affordable and be able to be in the place that you're in. So why not do that when you buy a house? Most people don't know this, but you can have up to 4 borrowers on a mortgage application. That's 4 people that you can use their income to qualify for a house right now. So when you take 2 people, you are doubling the income most likely. Now expand it by 4. Imagine what you can afford with 4 roommates. Of course, you want to trust these people. You don't want to go into home ownership with somebody you don't trust. Hopefully, most likely, if it's a roommate, family, cousin, something like that, hopefully you already have a level of trust. But this is another way to be creative to actually qualify for a house. And you're still doing the same thing. It's still a roommate situation, but it's ownership. And you need to consult an attorney about the splitting of equity when you go to sell. Make sure the documents are drawn up to where it's fair. If and when you move on, which you probably will at some point. At some point, you may grow a family and want to get out of the roommate situation. But at that point, hopefully you're walking into some equity and you're walking away splitting money that you have made by owning that home instead of renting. So how does the down payment assistance program work? Where does that money come from? Do you have to pay it back? So there is 2 ways this program works. One is through a grant, which means the money is forgiven. It is truly free money that they are giving you for your down payment. The next and more common that we see is a second silent loan. So let's say your down payment is $12,000. They will put a lien, a second mortgage on there, a silent second is what they call it, in the amount of $12,000 that you are not making a payment on until you refinance or you sell the home. So if you go to sell the home at some point, that has to be paid off. So it's not truly free money, but it's borrowed money that you're not paying any payments on. So it's as close to free as you're going to get. Credit scores. So what is needed to qualify for these programs? There is not one specific answer. A lot of times they'll look at the totality of your financial situation, who you owe money to, are you in collections, things like that. The general guideline is we want to see a 600 in front of your credit score. There are some cases where we can go as low as 580, but that is not optimal. You want to be in the 600s. Again, there's a link in the description below on some credit hacks. If you feel like your credit is low, you need to find out what's dragging your credit score down and then attack that at the choke point to get those credit scores up. And like I said before, sometimes it's easier than what you think, and sometimes it requires no money, but a little bit of negotiating with the creditor who is reporting the negative or derogatory trade line. So right here are the minimum credit scores depending on which program you go with. So for Chafa 620, for Chenoa 600, somewhere around that range. So you really don't know what your true credit score is until you have your FICO pulled. We see a lot of people say, well, Credit Karma says this, or I bought a car and they say this. Those numbers are never lining up with your true FICO score. So in the mortgage industry, how you determine credit score is you take borrower 1, borrower 2, you have 3 trade lines each. So you take the middle score from both the borrowers, and that's the credit score you use. So that is the way that in the mortgage world, your credit score is actually determined, is the lowest person's mid score. That's what's used. Keep that in mind if you have a borrower and co-borrower, that the lowest common denominator is going to be what you're going to have to use. So far as credit repair, like I said many times, you can do a lot of this yourself with making some phone calls, but you have to have a strategy going in and find out what's dragging your credit score. So we have a credit scenario runner that shows us why your credit is low and some things you can do to boost that. Sometimes in certain cases, it is too much and too ugly for us to be able to handle with just some simple phone calls. So that may be the point where you need to reach out and we have referrals or references to a credit restoration company that's going to actually help you fight the creditors to get your credit score up. That can be a lengthier process. So now that we've gone over how easy it actually is to get into a down payment assistance program, now you have to decide, do you want to rent or do you want to buy? That is a personal choice you need to make. And of course, whatever you go with, hopefully is the right decision for you. But I at least wanted to provide you with the information on how this actually works, since there's so many myths out there and ways that people get scared off before they even give it a chance. If you have any questions at all, which you may have a lot, I tried to breeze through this because I know people are busy. Feel free to call or text or email and ask me how you can get into this program or whether you qualify. We can take a look at your file in its entirety and see if you are a good candidate for this program. Look forward to seeing you on the next video.